Hello friends, good afternoon, and I'm CA Deepak Gupta. I welcome you all in our today's webinar. And like we can see that we have already reached 500 participants, and today we have among with us very senior partner from the Deloitte, CA Sidhwa ji, who will take up our today's lecture, and Avinash Gupta ji, who is the moderator of the session, and I welcome SAngam Aggarwal ji and Grish Ahuja sir, who is also among with us. Now, without wasting much time, I will hand over to Avinash ji or Sangam ji so that we can start it today on time because yesterday many people are saying we were late in starting the webinar. So over to you, Avinash ji and Sangam ji.
So welcome friends. Today we are dealing with a very important topic. So this is day 3 of our series, 7 lecture series. The day 3, the topic is taxation of royalty. So as we know, under section 9, subsection 1, clause 6, royalty is taxable in India by 3 categories, and there is a treaty definition also on the royalty what India have entered with other countries. And there was a big issue and big problem with respect to the taxability of the software, because many times we are confused if we are buying a Microsoft, if we are buying MS Excel, if we are buying tailor-made software, off-the-shelf software, or some customization is being done, whether we have to deduct tax or we have not to deduct tax. And there are other problems with respect to database access charges, whether they amount to royalty or they are not amount to. So this today's session is dedicated only on one topic: what is the position as far as the domestic law is concerned on royalty, vis-a-vis what is the situation in the treaty law that we have. And for this we have the best faculty available on this topic is Rohinton ji. As a protocol, I have to introduce him, but I think he is one person who do not require any kind of an introduction. He is the senior partner of Deloitte in India, and he is practicing for more than 25 years in this field, and major judgments on the royalty are his clients. So he is deeply involved on the subject, not from the perspective of a viewer of a judgment, but also a person who drafted the agreements for royalty, who have actually represented the cases before various authorities, including assisting the big lawyers at various levels. And we know that software is one which is pending before Supreme Court to finally decide. But yes, there are many other issues which are almost settled. There are certain issues by changing a small comma or and in the agreements, the meaning is changing. So we have Rohinton ji with us, so he will take us through with all the provisions and nitty-gritties. So I welcome Rohinton sir for accepting our invitation on a short notice, and now the floor is open for you, sir. So we request you to please start your deliberation, sir.
Thank you very much, Avinash ji, for your very kind introduction. Some of the things that you said about me are not exactly true also, but it's fine. Let's get started, and hopefully this large audience can benefit from the knowledge you have and some of the other attendees have, which can then increase our combined knowledge about the subject. Nobody is an expert on this subject because it continues to evolve. So let me try and set the stage by actually going through things at a very basic level to begin with, before we get into some of the controversies around the subject. So before we get into controversies, it's always good to have a good understanding of the definitions, the law, how royalty is currently being taxed in India, how the computation mechanism works, what are the impact of the double tax treaty, and then the interpretational issues that have arisen both under our domestic law as well as under the treaty. So let's get started with the royalty definition. Now, I've tried to kind of reproduce the definition under section 916 over here, and basically there are 4 buckets under which royalties typically get covered. The first bucket is pertaining to patents, inventions, model, design, secret formula, process, or trademark or similar property. And there, what gets taxed as a royalty is the transfer of all or any rights, including the granting of a license, the imparting of any information for the working of or the use, and the use of that IP. So if you see, the first category is very strong, typical intellectual property that you would normally see as something constituting a royalty. The second category is slightly different. It talks about technical, industrial, commercial, or scientific knowledge, experience, or skill. So what it says is that IP can be the types which is typically patentable, which is articulated in the first bucket. But there are also certain types of patentable experiences which can still give rise to income in the nature of royalty. So that's again a very different bucket. The third bucket is the use of the right to use of any industrial, commercial, or scientific equipment. Again, completely different type of property. Any kind of equipment which is used or given the right to use does not get categorized as business income, but gets categorized as royalty in this particular instance. And the last part is, again, we are moving towards intellectual property, but this is more pertinent to those which are specifically being copyrights, especially of literary, artistic, scientific works, including films or videotapes for use in connection with telephone and radio broadcasting. So there also, again, another category being created, out of which the transfer of all or any rights is being taxed as a royalty. Now, this was the basic type of income which gave rise to a royalty. But then a few years later, what happened was Finance Act 2012 inserted some explanations which some say are, while the tax department says that they should have always been read into the earlier definitions, but many courts have taken the view that they have expanded the definition of royalty. And now let's see what is it that is sought to be covered over here. Explanation 4 talks about the use or right to use of computer software, irrespective of the medium on which such rights are transferred. So a specific inclusion for computer software. And as we go forward, we will see why that was made. The explanation 5 is a wider inclusion to say any consideration in respect of any right, property, or information, whether or not such right, property, or information is under the control of the payer, used by the payer, or is located in India. So again, widening of that scope. And explanation 6, which talks about process. So some of the judgments that happen for satellite companies and telecom companies, especially being used to cover up the scope of the royalty article. And over here they say that any process which includes transmission by satellite, whether uplinking, downlinking, amplification, or whatever, cable or optical fiber, or any such similar technology, whether or not the process is secret, because of, again, to get over certain judgments of the courts. So this is now the expanded definition of royalty. Now, as you can see, there are a number of components to this definition. So the first slide, we had patents and inventions. Then we had the use of imparting of knowledge, which was termed to be an intellectual property. Then there was the use of equipment, which is again covered. Then the copyright, whether literary or artistic. And then the expansions that we have on software, on telecommunication processes, and the overall expansion and explanation 5 about control, usage, and location. So this in sum actually constitutes the overall definition of royalty as it currently stands under our domestic law. Now, as I said earlier, there are multiple court rulings as to whether the definition of royalty has been altered or it has been clarified. There are decisions which have said that the amendment of the income tax amounts to some sort of expansion of the definition, and therefore does not automatically have an analogous effect to DTA interpretation of royalty. And at the same time, in Verizon communication, the Madras High Court relied on the definition and said that that definition, which is retrospective under domestic law, has in fact have to be read into the India-Singapore definition of royalty as well. And therefore, they kind of assume that this explanation was clarificatory. But let's not get swayed by some of these judgments at this point of time. Let's probe a little further into what exactly is that intellectual property that gives rise to royalties. Before we talk about that, there's an important exemption that exists under our domestic law with regard to royalty in respect of computer software, which is exempted when paid lump sum for transfer of all or any rights with commercial instrument for any scheme approved under the policy for computer software export, software development and training. This is exemption has probably outlived its utility, as it's largely not very much used at this point of time. But there was a policy, and most of the STPIs and SEZ units availed of some of these benefits. But let's understand exactly what is it that truly constitutes royalty. And for that, let us break the transaction up into different parts. So first, let's consider what is the product itself, what is the embedded intellectual property in the product, what does the licensee of the product get, and what does the purchaser of the product get. And towards that, one can then make an educated guess of what constitutes a royalty and what in fact does not constitute a royalty. So let's take the first example. Say you go out and buy a drug from the chemist. Usually the drug is patented and there is a particular IP embedded in the drug. Now, when you swallow that drug, does that mean that as a purchaser, you have got, because you're using the IP, it's embedded in the medicine and you are consuming it, and therefore can it be said that as the purchaser, you have got a particular IPR? And the answer to that is a clear no, because the person who actually uses the IPR is the person who's licensed to manufacture that product, and the payment that the manufacturer makes to the owner of the IPR for the license to manufacture the drug is actually what constitutes the royalty, whereas the consumer of the copyrighted product is actually merely a consumer of that and doesn't really make a payment which is tantamount to royalty. And I'm trying to make this distinction for the various other types of property which has intellectual property rights embedded in them. So look at books. When you buy a book, at that point of time, obviously the publisher has the author has copyrighted that particular title. The publisher pays the author a royalty for the ownership of that particular title that the author has. And the payment that the publisher makes constitutes a royalty. But when I buy the book, at that point of time, I'm just the owner of the book. I'm allowed to read, I'm allowed to look through the product, and I own that product. But that payment which I make to buy the book does not constitute to be a royalty. Similarly with, say, something like packaged drinking water. So you can buy packaged drinking water. It has maybe a logo on it, says it is bottled next to the Himalayas. And it might, based on that, it might sell at a much higher price in the marketplace. But again, over there, the manufacturing and the bottling rights could have been given to a franchisee who merely bottles the product, but the ownership of the trademark and the money due from the franchisee to the owner of the trademark, that would be a royalty. Whereas if I bought a bottle of water, that is merely buying a product. It's the same way with a washing machine. Typically, these are all licensed out to manufacturers, and the licensee is the one who pays the royalty, and the consumer is the one who actually pays the price for ownership of the product. Now, these examples are important for us to understand the concept of royalty, because while this definition seems to hold for certain types of intellectual property, when it comes to other types of intellectual property, the examples get blurred. So let me give you maybe I can twist the second example. So in the second example, it's a case of books. Now, if you buy a hard copy of a book and you consume it, there's no doubt that that payment which you have made is for ownership of that book title. But suppose instead of buying a physical copy of the book, you decide to purchase the copy of the book from the Amazon bookstore, or for your Kindle, for instance. Does that distinctly change what rights you have got? Just because that book is not published in paper, does the payment which you are making to the company that is selling you that soft copy of that book, does that change and suddenly become and constitute a royalty? That is something that is being debated for a long time. And as you can see, in India, it's been a very significant amount of litigation around this very aspect. So let's move on and talk about how now the entire discussion translates through a tax treaty. As you know, under our domestic law, we have section 90, which says that if there is an agreement with a foreign country that India has entered into, then in that case, the provisions of treaty, if they are more beneficial, they can apply. Similarly, section 90A allows for double tax relief where treaties do not exist. But where a treaty does exist, we need to look at whether the payment which is being made constitutes royalties, which is taxed under Article 12 of the treaty. And in case there's a PE, whether that will then get taxed under Article 7 of the treaty. And the commentaries which guide us are the commentaries which are being issued by the OECD under the UN Model Convention, and some of the commentaries from the model tax conventions that we have entered into. So this is the background framework which we need to look at when we are evaluating tax treaties. Now, royalties under Article 12 are also interpreted in different ways. So the article works mechanically, and each sub-article of Article 12 decides on how the tax of royalties will happen. So the first Article 12(1) decides who should have the rights to tax the royalty, whether it will be just one state, whether it will be both the states, or whether it will be only the state where the royalty is being received. So the first article decides on where and who has the rights to tax. Article 12(2) talks about an overall ceiling that cannot be exceeded for a royalty, and typically prescribes a rate. So they say that tax, if it is taxed as a royalty, the amount of royalty which can be taxed cannot be more than, say, 5% of the royalty paid. Article 12(3) then goes further to define what the term royalty is. 12(4) then talks about what happens if a royalty is effectively connected with a permanent establishment, because then a kick out rule applies in that case. Article 12(5) talks about the source rule for royalties. So if the payer is a resident of a source state, then the royalties are deemed to be sourced in that source state. If the payer is a PE in that source state, then the royalty is deemed to arise in that source state. So there are sourcing rules which can be put in over there. And then Article 12.6, which occurs in some treaties, is the adjustments for related party transactions that can be made against those royalties. So this is the overall scheme of the agreements under the OECD Model Convention and the UN Model Convention. The UN Model Convention is a little wider because it includes films and tapes used for radio and television broadcasting, and it also includes the use or right to use industrial, commercial, or scientific equipment. Now, mind you, till a particular point of time, the OECD model also included this, but there was a major revision to the OECD model that was carried out where the use of or the right to use industrial equipment was moved to tax under Article 7 in the presence of a permanent establishment only. Whereas under the UN model, just like under our domestic law, the use of the right to use of equipment still features under royalty. So it's a question of where it's decided to be taxed. Under the UN model, it's considered to be taxed as a royalty, whereas under the OECD model, it's taxed if there is a PE. So how is royalties tax for a company? Now, in the case of a foreign company, what is taxable is the income that accrues or arises in India, or is deemed to accrue or arise in India, or which is received in India. Now, if you were to kind of break that up, and we've created a kind of a little flow chart so that's easy to understand over here. So in this example, and this is how we would decide on where it is taxed or not taxed. So the starting point is a case where a foreign company provides some technology or services to the Indian company, which is subject to tax as a royalty or FTS. And the starting point is to ask whether the foreign company has a PE in India. Now, if it has a PE in India and the payments for that royalty is attributable to that PE, then it's straight away taxable in India. But suppose the foreign company doesn't have a PE in India, it can still be taxed under the deeming provisions of 916. And then you need to look as whether that royalty is deemed to accrue or arise in India. And if it is, then it is taxable in India. But if it is not, then it is not taxable in India. So this is the basic rule that one has to apply to determine taxability of a foreign company that has income in India in the form of royalties or fees for technical services. Now, that might change where, say for instance, in the case where the payer is an Indian resident, there are certain provisions under our deeming rules that say that where the royalty is being paid and it is utilized in a business or profession carried on outside India or for the purposes of earning income from any source outside India, then in that case, there is an exemption provided under 916, which says that where it is so utilized outside India, it will not be taxable in India. So again, one needs to see whether the royalty that is used is for the purpose of a profession carried on in India or outside India. And again, there are judgments around this as to where it is utilized. So say for instance, there have been case law which says that if I am an exporting company and I'm paying payments for, say, increasing the production in my factory, but my entire production is for export, can it be viewed as a business or profession carried on outside India, which it certainly is not, or for the purpose of earning income from any source outside India, which may be the case. And their courts have decided as to what is source, but that discussion is perhaps beyond this particular coverage that we have for today. Now, in the case where the payer is also a non-resident, which can again happen, there also the deeming provisions can apply. And if the payment is in respect of a business that the non-resident carries on in India, then just like the treaty, the domestic law also sources that royalty to India, and India then has rights to tax it under our deeming provision as well. So in this example here, earlier example, the payer was a resident. In this example, the payer is a non-resident. And again, the opposite scenario applies there where it is utilized For outside India, it's not taxable. Here in the case, it's utilized in India, it would become taxable.
Rohinton sir, can I interrupt for 1 minute?
Sure.
So Rohinton sir, there are a lot of queries which is coming up. One is on your book example that you have covered late this time, and one more request is the two scenarios that you have discussed. So can you give some live example by giving some practical scenario where the royalty becomes taxable? So that will be helpful for people to understand this particular aspect.
Sure. So I'll just come back to the book example that we were discussing. And actually, this is one of the highly debated areas, at least in India. The question is that if you have, so there are two areas which are debated, right? The area which is debated is, when do you make use of a copyright or an intellectual property? Do you make use of it when you buy a product, or do you make use of it when you manufacture a product which has got intellectual property embedded? Now, the general view which courts have been taking, and which is also the generic interpretation in many judicial forums around the world, is that the usage for the purposes of defining royalty is that it is used when the intellectual property itself is actually used. So when you use an intellectual property to manufacture a product or to create something, then in that case, the payment you make to the copyright owner is actually a royalty. But when you buy a product that has been created after usage of that, you do not actually use the intellectual property. You might be the user of the product, but you don't actually use the intellectual property per se, and therefore the payment that you make is not a royalty. So coming back to my book example, whether I buy a book in a physical format or whether I buy it in a soft format, the payment that I make to the publisher should ideally be still classified in the same way, and it does not convert itself into a royalty just because the format of the product changes. Now, there are views to the contrary to this. This is what I'm talking about is my personal view, because the word use put into the definition of royalty is caveated with the instance of it being used, the intellectual property itself being used, and that's what gives rise to a royalty, and not the use of a copyrighted product or a copyrighted article.
So,
Does that answer the question?
Yeah, sir, I take, sir, 4 examples. So please give your views. So the first is, sir, I buy a copy of a Income Tax Act. So what I buy from any publisher, which is a pure copy of a law, bare act of income tax. Second is, I buy a book written by Girish ji, which is any author have written Income Tax Act in a format along with judgments, along with his views, along with cases, etc., which is a public document. Third is, I buy a journal which is the composition of the case laws. So maybe I buy a ITR, I buy a taxman copy, or I buy any other journal which consists of case laws. And fourth, I buy a journal which is confidential in nature, which considers and consists the research being undertaken by various people. So in all the 4 cases, I believe the underlying factor is that I cannot use all 4 commercially. So then what would be the situation of royalty on these 4 examples?
So I think all the 4 examples have one common thread, and I'll try and pull that common thread out of all the 4 examples. So as I said earlier, the definition of use as read into the royalty definition is a limited use of intellectual property, and where you receive an article which is being made after putting that intellectual property into it, the article that you receive does not mean that you will use the intellectual property. Now, I'll flip that discussion the other way. If that were the case, then anything that is sold directly to a consumer of the article, the payment will never be royalties. So say for instance, if I am an author and I I pay a publisher to publish my books and give it to me, and he's like just publishes it and gives it to me at cost. Okay, whatever is cost, I pay for his paper and everything. I am the owner of all the intellectual property in that book, and I start selling those books to stores. Suddenly, based on what I've told you so far, there is no royalties ever that can arise in that situation, because what I'm selling is a property that has already got the intellectual property embedded in it, and as a consumer you are receiving a book and you are not making use of the intellectual property per se. So I think the there are arguments to go both ways. If we were to go as per the argument that the use implies that it has to be the use of the copyright, there can be situations where certain transactions can be structured in a manner where there is never a use of a copyright. So another example could be, if you remember the good old days, Avinash, when you and I were probably learning how to run a computer, we actually went to a store to buy a copy of Windows 95. I remember when it was launched, I stood in line to get a copy of Windows 95. It came to us in a cardboard box, and there were 6 floppies in it to install it onto your computer. Most of our audience may not even know what floppies are. But what happened is, at that point of time, the technology was such that if you sold a software, you had to burn it onto another medium. That medium had to be physically sold. And therefore, it was very clear at that point of time that the payment that whoever was making, so Microsoft India perhaps was there in India at that time, they would burn the floppies and they would make a payment to the copyright owner in the US or wherever it was. That payment was clearly a royalty. But things suddenly changed when you download a copy of Windows directly from the internet. It comes directly over the computer. What you're receiving is exactly the same what you had received earlier. You could argue the same thing, that all I've got is a copyrighted product, but suddenly that royalty payment, which was very clear at that point of time between Microsoft India and say Microsoft US, that suddenly vanished. So today, you as a consumer are directly paying to a company somewhere outside, and we don't term that payment to be a royalty. Now that significantly changes the transaction and our ability to tax those type of transactions in India, which is why the expansion of 916 to that extent has happened. Because if we didn't have that expansion, and we continued with the existing treaty definition, those payments will never be taxed in India. And in fact, the OECD actually acknowledges this in its commentary, that what could have been taxed as a royalty can today escape being taxed as a royalty, especially in the situations of software.
So if I conclude this entire discussion, what I understood, please correct me, Rohinton sir, if I am wrong, that in the first case, when there is an income tax act, so it is, we are not using the IPR of the act, hence it is not royalty. Second scenario is about the book authored by any author. In our example, it is being a book authored by Girish ji. So in that also, we are not doing any commercial exploitation of the act, and we are only buying a book. So again, it is also not regarded as royalty. The third scenario is a journal where only a public information or a court judgment and anything which is published in a newspaper or any other thing is being compiled. So again, we are not buying and using the IPR of that, so it is again not royalty. In the last case, what in the last example, when we have some secret information or a research which may not be publicly available. So now in those scenario, we have to see whether right to use those research is available or not. If it is available, then it may be classified as royalty. If it is not, if the right to reuse is not there, then it is not royalty. Am I correct, or there is some disconnect in this, sir?
No, I think broadly you have correctly captured the discussions. So in the last example, if it is something which is a secret information which may or may not be copied. So in all cases, processes and secret things may not be legally protectable by applying for a patent or applying for a copyright, but may still be secret. In those cases, there is inclusion in the definition of royalty for those type of secret processes as well.
Okay, and sir, now a request have come from a participant. Sir, in the slide that is open, where a non-resident is making payment to another non-resident and still covered as royalty, can you give with an example when this
Sure.
situation might arise?
Sure, it happens all the time. So especially if one of the non-residents has a branch in India. So if there is a non-resident who has a branch in India and is now making payment on account of a royalty, that royalty is utilized for that branch in India. It is utilized in India for a business or profession and carried on in India, and hence it could be taxable in India.
Thank you, sir. So we can take it forward.
Okay, so this table basically summarizes the utilization and who the payer is and whether it's taxable in India or taxable outside India. So we've already covered this. Let's now look at the deeming provisions a little bit more. In this case, the payer is an Indian resident, and the Indian company is making payment to a foreign company for the royalty. And in this case, clearly the payment will be taxable in India because it is in respect of the business of the Indian company in India. But suppose the payer is a non-resident, and say foreign company one provides technology to foreign company two. Foreign company one, however, has a PE in India, and if it does, and it is incurred and borne by the PE, and this is the example I gave earlier, is that if it is incurred and borne by the PE, then that payment made by one foreign company to another foreign company would be deemed to accrue and arise in India under Section 916. Typically happens where there is a branch in India. So these are the deeming provisions for a non-resident. If it is utilized in India, it's still taxable in India. If it is utilized outside India, it's not taxable. But for an Indian residents, typically wherever it is utilized, it's typically taxable in India. Now let's look at computation and how the provisions compute the tax on such royalties. Now, where the payer is an Indian resident and the payment is made to a foreign company which does not have a PE in India, then in that case, typically the amount is taxed on a gross basis. So under our domestic law, it's 10% plus surcharge. But if it is taxable on a net basis and it's income of a PE, then it will be taxed as business income at 40% plus surcharge, but on a net basis after allowing all deductions. So this is how taxation occurs where the payer is an Indian resident. Now, what happens where a payer is a non-resident, and over there again, it will be taxable on a net basis for the foreign company, and it will, I'm assuming it will have a PE in India, and it will be taxed at net basis at 40% plus surcharge. So the net basis taxation is permitted under Indian law, and there is a specific section that deals with when it will be taxed on a net basis, and that happens only where the foreign company has a permanent establishment in India. Otherwise, it gets taxed on a gross basis. And in order for it to compute its profits, under our section 44AA, you are required to maintain books of accounts and also have an audit report in form 3CE to compute the net basis of taxation. Now let's go into another scenario as to on computation again, where the payer is an Indian resident and it's paying to a foreign company which has a P in India. Again, if it has a P in India, it'll be taxed on a net basis. But if it doesn't have a P in India, if say for instance it's paid to a related party, then taxable on a gross basis, but where the consideration as per the TP rules, it could still be taxable on a gross basis, but it has to be at an arm's length. So typically there are a lot of such payments that occur from India, especially where an Indian subsidiary of a foreign company is making payment of royalties to a related party. And again, on a, in the case of a non-resident, on a net basis. Then let's go and see how the PE clause actually operates under the OECD model and the UN model. Now, typically royalties is always taxed on a gross basis unless the beneficial owner of the royalty carries out business in the other contracting state through a PE, or the right PE, and also the right and property in respect of which the royalties are paid are effectively connected to the PE. In such cases, the royalty article kicks out the charge from Article 12 and it moves under the business article, Article 7. There's a similar provision under the UN model, except with the additional condition where performing services, independent personal services from a fixed base, because the UN convention also talks about the fixed base as with regard to independent personal services, and that is added into this article. So it links Article 7 and 14. Article 14 deals with independent personal services. So in those cases where a PE arises or where there is a fixed base and the right and property for the royalties is effectively connected to that fixed base or the PE, there is a kick-out provision to either Article 7 or Article 14. The OECD model doesn't have an independent personal services article because that has been merged with Article 7 itself. So that's why it doesn't feature in the OECD model.
So Rohinton, can you explain this again? So what you are trying to say, please correct me if I am wrong in this. So normally we say that royalty income is taxable under article under the respective article, but OECD model and UN model says when if it is effectively connected with the permanent establishment situated in India, then those article of the gross basis will not apply. It has to be the tax has to be deducted, or if the taxability is on the net basis, means that amount revenue minus expenditure.
That's right.
I think Giriji also wants to say something. Sir, are you please unmute, sir?
Same as Article 7, business profits. I said that only.
Okay. So in all cases, we have to check the PE part also while making the payment to a non-resident.
Yes. So typically, if the non-resident has a permanent establishment or the payment which is being made is connected with a permanent establishment, automatically the scheme of taxation changes. So in that situation, the Article 12 has a readjustment or a kick out, I call it the kick out clause, which kicks out the income from under the royalty article and slots it back into the article pertaining to business profit. Okay. So this is very important to understand as what is effectively connected with such PE and when does this kick out typically happen. Now, if typically royalties are taxable in a source state only where they are paid from the source state. So typically that's when the source state begins to have the rights to tax that royalty. And they typically do not extend to situations where, for instance, a foreign company may have a branch in India, but the payment of the royalty may not necessarily happen from India. It might happen directly between the head office of the foreign company and the recipient of the royalty. And hence, in order to protect the tax base of the source country, typically this rule features in Article 12. So I hope that helps understand.
So, Rohinton, I have a question here, if you allow
Sure.
me. So what happened in a practical scenario? So there are let's take an example of Microsoft. So many of our clients. So because we are not there on the non-resident perspective, but I am talking about the 195 withholding perspective, because all of us receive invoices from our clients stating Microsoft invoice was there, and these invoices are typically coming from two sources. So there are a couple of invoices what we receive from their Indian offices. So Microsoft, I believe, is having a branch office in India through which they are making an invoice to the clients by including GST and other things. And in some invoices, they are sending it either from US office or a Singapore office. So when we can say that it is effectively connected, and when we can say it is not effectively connected, because Microsoft is having a PE in India, assuming. So as far as the withholding perspective is concerned, so whether there is any change if we receive the invoice from India or Singapore or US?
So, Avinash, in this particular case, and let's just talk generally of any software company, where if they have a PE in India, typically, and you are knowledgeable about them having a PE in India, then in that case, certainly you should ask them for two things. One is a rate for lower withholding under the section 195 read with 197, because then in that situation, the payment is taxed on a net basis, and you are not capable as a deductor for determining at what rate you should deduct, because otherwise you don't have details of their expenses, you cannot compute their profit, and therefore 195 provides that it is the income tax officer who has to compute that and then issue you a certificate. So in those circumstances, typically as a deductor, if the rate of withholding to be applied is going to be lower than 40%, because 40% is on net basis, but if there is no evidence of any deduction, then you would be forced to apply directly 40% on the gross basis. But typically in these cases, and it happens quite a bit, very often in the case of, say, foreign banks. Foreign banks typically are branches of foreign companies in India, and when you have to pay them, typically they would already have obtained a certificate from their assessing officer, which delineates exactly what is the amount of withholding to be done on any income payable to them. So if you suspect that a foreign company has a PE in India, my suggestion is to immediately ask for that certificate, which they would have, where they are obliged under law to obtain from the tax authorities. Now, assuming in this case you don't know that they have a PE or don't have a PE, ideally you have to exercise your own diligence. So one way of exercising the diligence is, you know, some person who's working for a branch of that company, and you know that they have a PE, so you might have that knowledge. Or you could go to them and say that, you please certify to me whether you have a PE or you don't have a PE in it. And as a deductor, assuming you have done your diligence, you are entitled to that extent to rely on what is feasibly possible to have been obtained in that situation. And typically in many such cases, we rely on a certificate which the payee gives us to decide whether a PE exists or does not exist, because it's not in our hands unless there is some sort of evidence to the contrary to decide whether a PE exists or not.
Rohinton, I have again, so whatever questions Rohinton I am asking is not my question. These are the questions of the audience, what I am getting from
Sure.
you. So one of the audience again asked a situation where a bill is coming, a bill of software or any other copyright thing have come from outside India, and they also have a declaration from that non-resident that they do not have a permanent establishment in India, and they deduct tax on gross basis. This is typically 10% as per the TT rate or as per 115A they have deducted. Subsequently, it was found by the income tax department that they have a permanent establishment in India and the tax has to be on the net basis. The deductor, the payer, whether is there any responsibility of the payer, or can the amount of tax liability can be recovered from the payer in India?
Oh, yeah. So that's a question which pertains to the withholding tax provision specifically, and not specifically on royalty, but I'll still try and answer that. Typically, in those situations where a deductor has to decide on what, so you also have employees who you employ. The employee makes a declaration to you, and you deduct taxes based on that declaration. You try and collect proof of what the employee has declared, and maybe at the end of the day you might discover that those proofs were not available and you still ended up deducting the tax at maybe slightly lower rate. In that situation, while you had the overall responsibility to deduct the full tax, you have done your best diligence, you have collected this, and I presume that under that scenario you can't be faulted. Even though the liability as a deductor is vicarious and severable, your liability as a deductor ends after doing that level of diligence. And if somebody were to try and fool you by giving a wrong declaration, then to my mind the liability then and the onus shifts to the taxpayer. So typically, and many times what happens is that where the taxpayer himself has discharged the liability for the ultimate tax, usually there is a benefit which comes to the withholder, saying that, and he can very well take the claim that the tax has already been paid and he should not be held liable for any shortfall. So typically, those are situations that can arise both in any type of withholding situation, not just international or royalty payments, but our law makes us as the deductor severally liable to deduct the complete and the full tax and to pay it within that prescribed period of time to the government coffers. Any shortfall or any delay results in penalties and interest. But having said that, courts have always erred towards saying that this is an additional responsibility which is cast on a payer, and as long as on a deductor, and as long as he has done that particular responsibility with full diligence, he should ideally not be penalized for the shortfalls. So if you have knowledge about the PE existing, and it is proved that you did have knowledge about the PE existing, and you still did not deduct the correct amount of tax, certainly you should be penalized. But if a false declaration, for instance, was made to you, and you relied on that false declaration after doing some element of diligence to test that declaration, then to my mind, it's in a higher court, it would be difficult to fault you for withholding.
I think Giriji want to add something.
Sure. No, I don't want to add. I just wanted to say he's rightly pointed about the due diligence. One thing we do also sometimes, we go to the website of that client, means the person who has given us this benefit. In the website, we can check up whether they have any permanent establishment in India or not. If we find that they have an office in India, then we can normally take from them that certificate that it is not connected with that permanent establishment. So what I'm trying to say, that is my part of due diligence also. Go to their site, their website, check up, do they have any office in India? If they have any office in India, certainly we will need to have a certificate from them, either it is not connected, or if it is, then you have to deduct 40% unless they give a lower rate of certificate. This is my version. I don't know whether I'm right or wrong. I'm not doing it, but Am I right? Then this is the system we normally adopt, that we see the site and find out whether they have any office in India or not. This is a part of due diligence.
So sir, I'm summarizing what Rohinton sir has said, and what you have said is that normally the payer has to rely on the declaration given by the non-resident. Once he relied on the declaration given by the non-resident, then the company do not have a PE in India. Then for as an additional due diligence, we can go to the website of that non-resident and see whether they have any establishment, office, or any other place of business in India or not. If they do not have, then the matter is over. Then we can safely assume that there is no PE, and subsequently, even if they have a PE, there is no responsibility of the payer. But if they have an address, they have an office, they have an establishment here, then we have to take an additional declaration, whereby we can take a declaration that even if they have a PE, but this payment or this software payment is not effectively connected with this PE already situated in the country. Or they may take a lower deduction certificate, because in many cases I have seen that they, for this particular payment, they have a lower deduction certificate, which is safe. So the safest part is to have a lower reduction certificate if they have a PE in India. So Rohinton sir, am I correct in this?
Yeah, and I would say one way of doing the diligence is looking at the website. But say I'll give you another example which across, where there was a news article about that particular company that the tax authorities had held. They were assessing whether they had a PE or didn't have a PE in India or not, and there was a litigation going on in that regard with the tax authority. Then what do you do? So again, over there, one needs to do a little bit of diligence, and typically where the tax authorities are already making an assessment on a foreign company where they suspect that there is a PE, and perhaps suspect that the royalties are connected to the PE, there again, one should be very circumspect about issuing a no PE type of certificate, and one should question those certificates. So diligence means not just accepting whatever is certified to us blindly. As CAs, we have the overriding obligations to test that. And just as we audit a company with a suspicious mindset, not I'd say that's not the right word, but with a mindset which is meant to go and test and not just accept what is given to us at face value, the same sort of suspicion should be applied to a certificate that is issued to us. We should not accept it blindly.
Okay.
Shall I move on, Avinash?
Yeah, please, sir.
Okay. The UN model talks about a limited force of attraction rule when it comes to tax royalties. If the royalty is effectively connected with such PE or business activities of the same and similar kind, so the force of attraction rule widens situations where the royalty can be connected to a particular PE. Even if there are business activities of the same and similar kind of the PE, they get aggregated to apply the force of attraction rule. So this is something which is unique in the UN treaty, which is not there in the OECD model. Another very pertinent question comes up where a branch office pays royalties to the head office. Now, this is a typical case that can sometimes happen where you have either a project office or I'll take an example of a branch of a foreign bank that makes, say, an interest payment to its head office. Now, in all those cases, the question that sometimes arises is whether it is a payment to self and therefore does not result in any income, or does it still get swept into the definition of royalties because it's a payment to a resident of another state. So again, there has been a lot of jurisprudence on that. The argument against it is that it cannot be taxed because it's movement of money from one pocket to another pocket, and therefore that payment should not be taxed at all. And second, logic is that, well, ultimately, the branch is supposed to be a separate legal entity for the purposes of determining taxation, and therefore, since that artificial robe has been put on the branch under the treaty itself, therefore, can withholding provisions apply? But the overwhelming litigation seems to point out that it is that robe is being put on the branch office merely for the purpose of determining the profit of the branch as a separate legal entity, but not for withholding tax purposes. And therefore, such a payment should not be subject to withholding tax. Now, obviously, that can create certain types of scenarios where it can potentially defeat the requirement to tax such payments. But again, that is the way the provisions currently operate. Now let's go into some of the. Sorry.
So Giriji want to add.
I just wanted to add, there is some form is to be filled up. When in this case of interest remittance to its head office outside, they have prescribed a form. And if you fill up that form, then there is no question of taxing that amount because it is going to the head office. But there is a specific form. Offhand, I don't remember because I don't do much for the international taxation Indian, so I could tell you each form and each section also. But there is a form, some form is there already. So if you fill up that form, you can send the money without deduction of tax at source. This is there.
I see. So now let's just go into some of the real tricky interpretational issues that arise both under the Act and under the treaty. So the first one that I'd like to talk about is the issue of what is the source. So typically, is the source situated in India, or is the source of the payment outside India? Now, in the case of Asia satellite, the Delhi tribunal had given a decision saying the source does not refer to the person who makes the payment, but it refers to the activity which gives rise to the income. And this particular, even though it's a tribunal decision, to my mind, and I actually was part of this decision that was ultimately given, I felt the tribunal actually gave the right definition to source in this particular case, that it is not the person who makes the payment, but it refers to the activity which gives rise. And actually this principle has carried over into many subsequent judgments that have gone on the source of where the royalty is. So in the case of this German decision in the Madras High Court, it was held that the royalty paid by resident on export sales to a non-resident outside India, and it was held that the royalty was paid out of the export sales, and hence the source of the royalty is the sales outside India. Since the source of the royalty is from the source situated outside India, the royalty of the export sales is not taxable. Now contrast that with there's another decision of Hevels, which is of the Delhi High Court, which again goes back to the Asia-Sat principle and has actually contradicted this Madras High Court principle, saying that the source of the income is the activity of export manufacturing which took place in India, and therefore the source is India. And even though the payment is made for sales that are happening from outside India to an agent outside India, the source continues to be in India. Again, this is still something which is being debated at the level of the high courts, but the question is whether the source, the definition comes from the activity, or does it come from who is making the payment, or does it come from where the contract to make the payment is situated. So say for instance, I made a contract to make this payment outside India with a person outside India, then does the source automatically move to the place where the contract was made? Does the source move to the place where the activity of earning the income was made, or does the source go to the place where the person who has received the payment is situated? So again, this is a debate that has been happening, especially in the case of the deeming provisions, as to where is the source to decide whether the source of the royalty is in India or is in outside India.
So, sir, we are dealing with source just to identify the exception given under 916 clause B, that whenever a royalty is being paid by a resident in India, except the case where it was paid for a source of income situated. So, is it in that respect you are talking
Yes.
about the source?
But royalty, I'm concerned, sir, is okay. But the commission, if we are paying commission on that goods which I have exported, and a commission is paid outside India, although that circular has been removed, but still the judgment is that commission is not taxable in India. Royalty I can understand. Royalty I can certainly understand about this.
No, sir. Sir, there is a case of Farida Leather, Chennai High Court judgment, what you are referring to with respect to the commission. Now, what is the confusion, what many participants also have, that in case of the exception, specifically when we talk about the royalty, how can we determine that source of income is situated in India? I know there are conflicting views. So in your view, so how we can say that, can you give us an example where we can say that yes, source is situated outside India?
No. Let me tell you one thing. As regards royalty, fee for technical service and interest is concerned, there is already an explanation given under Section 9, saying that you make a payment outside India, whether that non-resident has any place of business in India or any connection in India or any, then still it is taxable. Place of business or residence or not. But as regards commission is concerned, there is no question of any the commission. I'm talking about commission. What royalty, fee for technical services, interest, there is an explanation specifically added under Section 9(1). But as regard commission, there is nothing like that. Therefore, if the commission is paid outside India to a person outside India, there still, after the removal of certificate, what you call that circular, still it is not taxable in India. Royalty fee for technical service, I fully agree with Rohinton, because there is an explanation there. That's why the source will be in India, even if he doesn't have any place of office in India.
Sir, I have a very good question with me, which I think will explain the question, the provision that we have. Sir, the question says that there is an Indian company who got a contract from Singapore to manufacture certain products. But to manufacture these products, he need a technology, and he imports that technology from Japan, and he is liable to pay royalty for the technology. Now, option one, that he uses the technology of Japan and do the manufacturing in India. Second, he takes the technology of Japan and does the manufacturing in Philippines. So in both the scenario, he is making payment of royalty. One, he might be paying royalty from India. He might be paying royalty from a branch office in Philippines. In both the cases, whether royalty is taxable in India, or in one case it is taxable, in another case it is taxable. In both the cases, he is exporting goods directly from the manufacturing facility to Singapore, and the consideration paid is royalty for the manufacturing process. Rohinton sir, can
Sure. So, Avinash, in the first case where the manufacturing is happening in India, I cannot but think that the source of activity, which is the manufacturing, is carried out in India, and hence the source is in India. In the second situation where you described about a branch office of the same company utilizing that royalty to do the manufacturing outside of India, I would tend to veer to the view that perhaps in that situation, the source of that royalty should not be in India. But again, there is a dispute on even that, because the way the tax department has been interpreting it, I have some situations where even in those situations, the tax department have held that the source of the activity, because it's the Indian company which is doing the manufacturing, continues to be in India. But I would probably go with where the activity is. As I said, the source has to follow the activity which gives rise to the income, which is the principle laid down in Asia Sat. And hence, based on that principle, I would veer towards the logic that what is being done when the activity is done in Philippines, and the activity for manufacturing is done in Philippines, the source of that royalty cannot be in India.
Okay. Girish ji, want to add something?
Yeah, let me tell you, this question was raised by CIT Gulati yesterday. Let me tell you, if in Philippines, their income is taxed there, then in any case, I'm telling you, if the income of that business, which is in Philippines, tax there, let me tell you, I fully agree with Mr. Rohinton that no question of being taxing that royalty in India. Because resident paying, acquiring anything in IPR or whatever outside India, using or carrying on a business outside India, or earning for any source outside India, there is no question that royalty will be deemed to accrue or rise in India. This is what I said yesterday also. I'm repeating the same thing. If that Philippine company has to pay tax there, that our branch has to pay tax there. In any case, that means I'm carrying on a business, a profession, a business outside India. And the moment I'm saying carrying on a business outside India, section 916, whatever it is, clause 2 will be applicable.
Okay. Okay, sir. So, sir, Rohinton sir, we can move to the next.
Okay. The next thing is the definition of what is imparting of information concerning technical, industrial, commercial, or scientific knowledge. As I had said, there are different levels at which a royalty is taxed, and there have been a number of judgments interpreting what is taxable and what is the imparting of this information. So one of the big judgments on this is by the Madhya Pradesh High Court in Hague Limited, where it was held that every information concerning industries or commercial ventures does not qualify as royalty. Some sort of expertise or skill is required. Some sort of confidentiality, secrecy, and exclusivity is required. It should not be something which is readily available in the market. And I think, Avinash, when you give your book example, which had some secret thing, maybe you were alluding to this. The second example is allowing access. This is Dun & Bradstreet case, AR ruling, allowing access and downloading business information reports, which is the compilation of publicly available data, is not a royalty. So this is it's an old AR judgments where the BIRs which were allowed to be accessed were basically compilations of information on companies which was publicly available, but which was compiled by Dun & Bradstreet into these reports, and they were being made available to their customers. So over here, the AR said that just allowing this access does not amount to a royalty. Then there is a tribunal decision of the Pune, which talks about how what is the length and advantage and experience that can be gained. So it says royalty signifies an extended or perpetual use for the payee, whereas FTS are relevant for one-time job and useful for which they are rendered. For example, the copyright designs or plans confer a time spread advantage to the payee. Similarly, information regarding an industrial experience in the context has to be interpreted as conferring similar perpetual or extended advantages. Else, there was no need to make a distinction between royalties and technical service fees. I believe these cases help us give some guidance. So every case stands on its own footing, but this helps in giving some guidance as to determine whether it is a royalty or not. We then move on to a very critical part, which we talked a little bit earlier also, so maybe I can move a little faster. And this is the definition of use. The definition of use as to be interpreted in the conjunction of royalty is very specific. So the Black Law Dictionary talks about use as being the application or employment of something, a long continued possession, and employment of a thing for the purpose for which it is adapted. The criteria for determining of right to use or even the use of equipment is there in the in one of the OECD reports. where it says the customer should have physical control and possession over the equipment. Customer must have a significant interest in the equipment. The provider does not guarantee revenues, and the provider does not use the property concurrent to provide services to others. So then there is also a judgment in Australia. The use of the right to use depends on the relationship which exists as a matter of fact between the person and the property, and it is best illustrated in this judgment of FactSet, which talked about the expression use of copyright is not to be used in a generic and general sense, having access to a copyrighted work. The emphasis is on the use of the copyright or the right to use it. In other words, if any of the exclusive rights which the owner of the copyright has made over to the customer so that he could enjoy such rights either permanently or for a fixed duration of time and make a business out of it, then that would fall within the ambit of phrase use or right to use of the copyright. So here, another slightly different tangent being added, that there must be an overriding exclusivity and a more permanent usage which is given over a fixed duration of time, such that a commercial venture can be made from that copyright, and that is what gives rise to royalty, and not just the use of a copyrighted article. So we labored that point early on this discussion as well. Now, the royalty definition also kicks out of it certain types of capital gains. So where the income is otherwise taxable under the head capital gains, it cannot be considered to be a royalty. And as for any capital gain, the definition of transfer comes into significance under section 247, which talks about a transfer of to include an extinguishment of rights, whereas the transfer of all or any rights are included. However, a carve out is done for the extinguishment of rights, which actually then is chargeable under the head capital gains. So many times where such ownership of the intellectual property is by itself transferred, then in that situation, that payment will be taxable as a capital gain and not as a royalty. And again, we have a number of judgments which have gone into under what situations such a transfer occurs. Sorry, somebody was saying something? Okay, let me move on. Then
yes, I think Sangam wants to say something.
Sorry.
Yeah. Research, in your example, when you said in Philippines, if it is taxable there, then it is not taxable in India. Is it material, sir, whether it will tax in the Philippines or not? Sir, unmute your mic.
Explain that you are having a plant in Philippines, as Avinash pointed out, to manufacture item there. Since you are manufacturing there, you must be paying tax at that plant also. That's a different thing. You are a resident in India, that income will also be included here. But what I'm trying to explain, you have a plant or a branch or something there, and you are paying, you are buying a royalty. That royalty which you are paying for IPR is being used in Philippines and not in India. So that's why I'm saying, even if I'm a resident paying royalty to that person, but that is taken from outside India, used outside India for the purpose of carrying on a business. Therefore, according to me, that should not be taxed in India, as Rohinton rightly pointed out.
Whether it is taxable in Philippines or not, it's not material, sir. Is it?
So point is, that means you are carrying on a business in the Philippines, then only you are paying, no? Or earning any source in the Philippines. The royalty paid for carrying on a business in foreign country or earning any source of income in foreign country. Obviously, when you carry on there, you will be liable for tax there also. The source rule, that's what I'm saying.
Okay.
Am I right, Avinash?
Yes, sir. What is important here is to see is not the source of the manufacturing. What we are paying royalty for manufacturing. So if manufacturing is in India, then the source to use that technology for which we are making the consideration is in India. So hence it is Indian source income. When the factory shifts outside India, the manufacturing facility shifts outside India, then the source is automatically shifted outside India.
That's what I'm saying. You are carrying on
However,
business outside India.
However, as rightly pointed out by Rohinton sir also, that income tax department is also disputing the second one.
I
They
know.
are saying ki, okay, you have a manufacturing facility outside India. We are not denying this fact, but ultimately business belongs to India. So that's why it should be taxable. So income tax department always want to tax it.
But the point is, when you are carrying on a business outside India, you must be paying tax there also.
So the considerate view of both these speakers, Rohinton sir and Ahuja ji, is that normally it should not be taxed in India when there is a manufacturing facility.
Sir, I'm really appreciating Rohinton for a wonderful deliberation he's giving. Just don't, if I'm interfering, it is only because some points were raised yesterday and I was a speaker there on Indian domestic law. I just wanted to clarify. Normally, I am not in the habit of, interfering, but he had made me a panelist like a moderator. He himself is. Sorry if I have interfered, but let me tell you, excellent deliberation you are doing it. Thank you.
So Rohinton sir, I'm sorry if we are interrupting you in between. Sorry, sir.
No, actually, we all learn from the questions being asked for the audience, and that's actually the true pleasure of doing sessions like this. So we get to have a wider learning. Everybody learns, including the speaker. So let's move on to the next part of this, which talks about the interpretation issues on royalties that have come up under tax treaties. So the question that has often come up is because of the language used under Article 12(1), where it says that royalties arising in a contracting state and paid to a resident of the other contracting state may be taxed in the other state. Now, the word uses paid. So then the question comes up is that what happens if I have just made a mere entry in my books to credit the other non-resident, but I have not actually paid? So under our domestic law, it's very clear that if you have accrued or paid, whichever is earlier, but that is very clear under our domestic law. But then under the treaty, it doesn't talk at all about accrual. It talks about where royalties arise and are paid to the other contracting state. So then a possible interpretation could be that the treaty actually is giving us a benefit. It says you disregard the accrual and you only tax it when it is actually paid. And in fact, there have been some favorable decisions in regard to this in the tribunal in Mumbai. In fact, a lot of lawyers have given views saying that the treaty talks about payment and therefore the accrual has to be ignored. However, in in the old AR decision, this particular aspect has come out very clearly, where it has been held that for the purpose of taxing such royalties, para 1 in fact is wholly irrelevant. It is also pointed out above that para 2 therefore thereof clearly lays down that the amount of such royalties and fees may also be taxed in India in which they arise and according to the laws of India. It is thus clear that the provisions of Article 12 of the treaty discussed above do not provide that the taxability shall be on a cash or receipt basis. I think after this AAR, much of the discussion on this particular topic has ended. But in case you do come across this, then I feel this view about the AAR has come out very clearly as the final word on this particular issue. The other thing that has often, got a lot of controversy is around the impact of the MFN clause. As you are aware, in many treaties, there is an MFN clause, which is also called the most favored nation clause. And in many treaties entered into, especially with the European Union countries, there is such a clause that says that if you give a benefit of signing a treaty with a lower rate of tax with another European country, another member of the EU, then in that case, as a fair, as the fact that we are all a consolidated union for tax purposes, that same benefit should be extended to me only. So say for instance, when the treaty with Germany was negotiated by the tax authorities at taxing royalty at 5%, that automatically triggered a lowering of rates in some other treaties as well. So many treaties that India has signed have this MFN clause, which says that the MFN trigger will apply when India signs a rate that gives a beneficial rate to another EU country in its treaty. So this also is something which needs to be looked at the time of, shouldn't blindly apply the treaty rate. If that treaty has a MFN clause, one needs to see whether that MFN clause has been triggered or not. Now, there is a separate dispute which is also ongoing with regard to whether the MFN clause can be said to be applicable regardless of whether a notification has been made by the Indian tax authorities or not. And there's again a lot of dispute around that. Some cases have said it is automatic. The tax department says, no, it is not automatic. It has to be notified that the rate has got lower. So that's a separate dispute, but we won't cover it. But the purpose of putting this here is that the rate applicable in the treaty may not be the final rate because of the applicability of the MFN clause. We now move on to another very interesting area which has also been debated, and it actually comes up quite often in many situations. And that is the supply of engineering drawings, designs, and technical documentation. Now, this is clearly a design which has enabled the buyer to operate a machine. There is no transfer of the license or copyright for that design, which allows the buyer to manufacture the machine himself. But the question is that then a royalty? That technical documentation which is supplied, is that a royalty or not? And in many situations that has held not to be a royalty. So if that design has not transferred or not created any right to this, so it again goes to that definition of use. So I think whenever you look at a royalty, this definition of use comes out very, very strongly. Does the article which you have received, is it an intellectual property that allows you to replicate or to have a long-term right to operate, or to have a certain advantage of that IPR for commercial purposes? And therefore, a lot of the technical documentation, which is just designs of the drawing, so you know how to repair it, or you know what is to be done and how it has to be operated, or you know how it has to be plugged in, that is not considered to be royalty. And in many situations, it has been held that it is an outright purchase of an article, and therefore it is not taxable as a royalty. So there are a number of judgments on this. So again, this complicates, as advisors to many of our clients, it complicates our life a little more, because increasingly business and technology tends to be far more complex. But the logic that has been used is, wherever you have to look at what is being used. Is it the article which is getting used, or is it the intellectual property which is getting used? And that becomes a decider as to whether the amount is a royalty or not a royalty. Software, we've discussed this.
Rohinton, can I ask a question here?
Certainly.
So now on this design, drawings and design part, so there are two questions that that I have. So one is, let's take an example of a prototype of a car. So case one would be that I am Maruti India Limited. So Maruti Suzuki Limited. I hired a company outside India who is a non-resident to design a new car for me, and I have paid for designing this car. So they have given me a drawing and design of a car, which is entirely a new car, which is not existing anywhere, and I am making payment for this as a consideration. Case one. Case two is that I, as an Indian company, is taking a prototype of Jaguar car from Jaguar UK, or BMW. I want to reproduce a BMW car in India, So I contacted BMW Germany to give me a drawing and design, and I'm making consideration to BMW or Jaguar. So is both the situation same and both are classified as royalty or not?
So I think we need to look at what was, so suppose you went and you purchased these designs and drawings that enable you to ultimately manufacture the car.
Yes.
So typically, if it's an outright purchase of those drawings and designs, one might argue that you perhaps made a payment for technical services. Those were technical services, and the output was the design, perhaps. But they are certainly not royalties, because you have contracted for something which you have bought from them, as opposed to, so it's like if I needed to publish a book, I went and purchased the generic copyright for some textbooks from NCERT. I made them a one-time payment and I started publishing those books. The question is that a royalty or it's not a royalty? So it depends on whether it is an outright purchase or whether it is the continued use of the copyright. Now, some of these situations can be very gray. It is possible that in those sort of cases, it could be also a little bit of mixed situations as well. But these cases have consistently held that the purchase outright of documentation, even though it might have some technical knowledge in it, does not amount to be a royalty.
So in our example, we can say that in the case two, where we are taking it from BMW and Jaguar, so generally they do not give an outright purchase. So they only give a license, or they only give a knowledge or technology or design. So it amounts to royalty. And in the first case, when Maruti have hired somebody to design everything, so it may be classified as a one-time purchase if it is actual facts say so. So then it may not be classified as a royalty.
Correct. It's very difficult to come out with black and white examples, Avinash. Many times these are far more complex than what we make them sound to be. But yes, the type of example you gave very much illustrates the examples that are there on the slide.
Sir, I agree that when we go to actual cases and actual facts of the case, there might be 100 more problems will come. But when I name the companies and this, so people and audience gets connected to it. So they start thinking of a Jaguar car or a BMW car. So it is some kind of this attachment to the topic. So that's why I am just giving you. So ultimately, I should not use the name of any company in between, but just to get connected, I use this.
Sure. Thanks very much, Avinash. So let me move on. We are now talking a little more about software, and under the Copyright Act, there is the meaning of copyright which is put in, which is the exclusive right in respect of a work to reproduce, issue copies, perform in public, make translation, etc. The OECD commentary also defines what constitutes a copyright, and they say that payment for exploitation of rights that would otherwise be the sole prerogative of the copyright holder, those constitute royalties. What does not constitute royalties, however, are payments for transfer of full ownership of the rights. So the same example that we gave is that if you have an outright sale of all the rights, it's capital gains to the copyright owner, or perhaps business income for the copyright, the owner or the creator of those drawings. Second is granting of rights for a limited period or for a limited geographical area. So there they have held not to constitute a royalty. The last sentence is there in the OECD commentary. Now it's debatable as to how they can restrict it like this, but to my mind, I don't think this exception applies for us with Indian jurisprudence, that even if it is for a limited period or for a limited geographical area, it can still constitute a royalty, because we have those situations. So say for instance, and now since you've been taking names, I'll use a name. So say for the restaurant Pin Baluchi or Haldiram's, there is a franchise given for the UAE operations, that could potentially lead to a royalty. There are also situations where certain brands might be licensed for a limited period or for a limited geographical area. Like for instance, say the brand is Mickey Mouse is licensed to Bombay Dyeing to put on its bed sheets, but only in Mumbai, not anywhere else. To my mind, again, there it would constitute a royalty, but the OECD commentary does a carve out for limited period or for limited geographical areas. Now, what constitutes royalty ultimately for when it's a software? Transfer of partial rights in the copyright, for example, license to reproduce and distribute the software to public. Transfer of know-how, secret code underlying the program, for example, the transfer of access code, algorithms, or some way to commercially exploit the program. What does not, however, constitute royalty is typically what we call shrink wrap software, acquisition of a program copy, where it's considered to be a mere purchase. Then rights given to multiple copies of a program for operation within its own business. So, sir, suppose you buy a license from Microsoft that I will use it on 5 computers, and you make copies to load it on those 5 computers. That act of making the copies is not considered as commercial exploitation. Payment by distributors to acquire and distribute software copies, again without reproducing. So say for instance, while today we buy most of our software directly from the vendor itself. So say for instance, if you had a Photoshop software, you can now only download it from Adobe. But in many instances, there are intermediaries or distributors who could be appointed in a country to actually redistribute the software copies. So they would get the keys, and they redistribute those activation keys within their distributor market. So there, that activity of just redistribution is typically not reproduction, and therefore should not constitute a royalty. Transfer of complete rights in the copyright also is not a royalty, because that typically is taxable as a capital gain. Now, this distinction between what is a use and how it gives rise to a copyrighted article and a copyright is very relevant, and this has been discussed in many cases, and still obviously before the Supreme Court also still. The distinction was made in Ericsson. It's in another situation in the case of Lucent, where the copyright was supplied with hardware because it was, the software was embedded in the hardware. It was held not to be a royalty because it was the purchase of the hardware itself. In the case of Infrasoft, it was held that the amount received by the assessee under a license agreement for allowing use of the software was not royalty either under the ITA or the DTA, but was in the nature of business profit chargeable to tax under its hands under Article 7. And it was held that other receipts on account of maintenance charges and training fees being incidental to the software receipts assume the same character. There is another decision of Reliance Communication also, which has made the distinction of copyrighted article versus copyright. And this is a standard thing. Delhi High Court has also held it in the GE case. Obviously, it's still getting debated in the Supreme Court. The Samsung case, which was held to be not royalty, as overruled by the Karnataka High Court, is now being in appeal before Supreme Court as part of the special bench. But almost all cases as of now, the bulk of the cases rather, have held that merely downloading a software and purchasing a software does not result in payment of royalty, but it is for a payment for the transfer of a copyrighted article. So this has been consistently held through. There have been other decisions in regard to database access. And in those cases also where the data is standard data and the access has been provided to that data, it has been held not to be a royalty. We already talked about the Dun and Bradstreet judgment, but there are many judgments which where they have held that this access to certain materials would not amount to be a royalty. Now, the question that comes after all of this is that while the intention is to tax these outflows from source countries on a gross basis as royalties, it seems more and more that it is possible to structure some of these payments in such a way that they are neither a royalty and hence nor a fee for technical service and hence cannot be taxed. And many times actually the supply chains, especially of large software companies, are set up to take advantage of this situation. Obviously India wants to combat this situation because it is definitely eroding our tax base, and hence we have measures such as SEP or equalization levy that sometimes get imposed because the inability to stem the leakage of tax on these sort of payments. Online advertisement is another example on which ultimately equalization levy has been put on. It was consistently held it was not a royalty or a fee for technical services and not taxable. And that brings me to the end of the presentation. Avinash, you've been asking me questions all through, but are there any other questions that I can help answer?
Yes, sir. So there are many questions that we have. So for your information, sir, I made a slightly thing. So I have already answered 126 questions on the chat tool, and there are 36 questions which are still unanswered.
Okay.
So first question is with respect to MLI. So the question comes, is there any change on the treaty definition of royalty or the position of royalty after incorporating MLI in place on Indian treaties?
I do not believe there is any change in the definition of royalty, Avinash. I don't believe so.
Or any other implication on the royalty article?
I don't believe so. The MLI made changes on account of BEPS, and there are large number of changes to implement BEPS. But as far as I know, as regards to royalties, there was no specific change that was made by the MLI. I need to go back and check, but I don't think so.
So I also feel the same, that there is no much change which is going to happen because of MLI. So the next question is whether the charges paid for cloud storage will be classified as a royalty to any person, or may paid to Microsoft in case of Office 365. So Microsoft also gives 1 TB space on the cloud for saving. So in two scenarios, one is the simply we take a cloud storage, whether it amounts to royalty, or second is when we pay to Microsoft for taking the space on the cloud, so whether it amounts to royalty.
Right. So taking space in the cloud is basically you're taking server space. So I would say that what you're doing is using equipment. Now that equipment so we have a definition in royalty for payments being made for the use of industrial, commercial, or scientific equipment. And to my mind, if you are renting some space on a server, then potentially that payment could be subject to tax as a royalty. With regard to the use of the software, so again, when now Office, as I said, life is more complicated and there are shades of gray all across. It's not a simple yes and no answer many times. When you gave the example of Office 365, Office 365 is a combination of the use of the software plus the server space. Now, how do you allocate between what is server space and what is Office 365? And the question that you need to ask is that if I can't allocate it, should I withhold on the whole thing? So if I were the withholder, remember, I want to play safe. I know there is a payment which is partly subject to tax and partly not subject to tax. As per the law, under section 195, if a payment is partly subject and partly not subject to tax, you are not the person who are capable of determining this. It has to go to the tax officer to determine whether that payment is, what is the rate of tax that is applicable on the payment. And I think that part is very clear based on the law that currently stands on withholding tax. I don't know whether that answered the question.
Perfect, sir. So I think you have answered the second question. The next question, what I am going to ask you is, so whenever there is a hardware and there is a software which have been embedded in that hardware, and the question is, and there is no value which can be determined for the software. So can we have to deduct tax on the software part? Second, can an income tax department will ask us to take out the value of the software and pay tax on the part of value of the software?
So that's a very good question. And actually, I had an example of one of the case law over there. I think it was Lucent, where it was held if the predominant nature, and some of the treaties also have that, where the predominant nature of the payment is for sale of property, and there is some incidental software or incidental services bundled into that overall payment, then the predominant nature takes over, and then it will not be a royalty or FTS. So that is the principle I would like to apply in this case. The question, however, is what happens if the predominant nature is actually the sale of software, in which case then the entire payment is subject to royalty.
Yes. So next question is, what are your views on payment made for booking a domain on godaddy.com?
So there is a pending litigation which is there in the Delhi High Court, which has held that the payment for domain is, the tax department has held that the payment for domain is a royalty. It's now pending before the Delhi High Court. I strongly believe that we will succeed in that case. But at this point of time, the outcome of that is pending at the Delhi High Court.
Yeah, I think Rohinton, we got a Delhi High Court judgment or a tribunal judgment which is in favor of revenue.
I think the tribunal has held that it is a royalty.
Yes.
And we are now in the Delhi High Court. We feel very strongly that that was a wrong judgment. But anyway,
Yeah.
that's it's pending in the High Court.
Because I think it is on a wrong footing at all. Okay, so next question is that when we say that there is a permanent establishment situated in India, what is the meaning of effectively connected with P? So how can one say it is effectively connected or not?
So good question. So effectively connected is that essentially the PE's business directly uses that intellectual property from, and the source of that payment is from that business. So say for instance, if I have a branch in India that is manufacturing a product and the technology comes for manufacturing the product from a foreign company, then the royalty that I pay for that technology is effectively connected to that PE.
Next, I think you have already answered, but still for clarification, because many people have asked. So people are asking that if there is a PE in India and they have to withhold tax at the rate of 40% on the net basis, but they do not know how much is the expenditure, the non-resident do not produce a certificate from the tax department, then withholding to be done at what rate?
40%.
On what amount? So I believe it should be done on the entire amount, gross amount, at the rate of 40% instead of 10%.
Yeah, because you are not competent. So the law does not allow you to make this determination. That determination is put in the hands of the tax officer. So the AO must make this determination, and you are not competent to make this determination.
So next question is about access right people are getting for accessing the online databases. So whether it amounts to royalty or not.
So we've covered some of that. Most of the online databases that you have access to, the courts have consistently held that payments are not in the nature of royalty.
Okay. Next is a very common question what people have. So if they have taken a SMS service from a non-resident, or they have taken as a bulk mail services from the non-resident, whether that amounts to royalty or not.
So what do you mean by a bulk mail service?
So they have taken a software through which, like MailChimp and all, they take some monthly money to allow you to send bulk mails to the recipient. So you can send 1 lakh mail in 1 minute, or 2 lakh mail in 1 minute, or you can send bulk SMS of 20,000, 30,000, 1 lakh people directly from the software. So they are charging money for the same. So whether it amounts to royalty or not.
Oh, I don't know. I'm not familiar with this business model, but it sounds as if there is some sort of service which is provided as opposed to the software. So the service being able to send 1 lakh SF. I thought it's illegal to send those SMSs, but I know I get many of them. So I'm sure there was a way around it. But it sounds more like a service rather than a license, isn't it?
Sir, all political people send SMSs. Sir, I think Girishji wants to add something.
I just want to say that in this case, if it is not royalty, then it will come under equalization levy, which has started from 1st April 2020. Because of this provision of services, that will come, there will be liable for equalization levy at the rate of 2%.
Because of e-commerce.
E-commerce, yes.
Sure.
Okay. Oh, sir, some people want a clarification with example on copyright and copyrighted article.
So I gave that example in the beginning of my presentation. So the book is clearly a copyrighted article. The actual ownership of the copyright lies with the author, and that is the copyright. And the book which is published is the copyrighted article.
Oh, okay, sir. I think we have covered most of the common queries that has been asked today. The smaller queries I have already replied on your behalf to the participant. So with this, I think we can end today's session. If any of our audience have any query, we can take up. Can anybody send us a query?
Sure.
So I think it is okay. So I'll hand over to Sangam ji. So Girishji, you want to say something?
No, thank you very much. I just wanted to tell them very good. It's an excellent deliberation given by Rohinton. That's all.
Thank you, sir.
I have understood many things, you know, because you can learn from anyone. And I have learned today exact version of royalty. There had been a lot of confusion. Still it is there. But I have many doubts have been solved by him. Thank you.
Sir, we got 193 queries till now.
Okay.
Thank you. Thank you, Rohinton ji. Thank you, Girish sir. Thank you, Avinash ji. Number of queries generally justify ki how the people are interacting with the person who's giving his presentation. So as much as query we are getting, that means people are very much interactive with the session. So I should appreciate the session, and really, sir, session was very beautiful, and we understand everything you explained in very in deep manner. So we are very grateful, and thanks to for coming on this platform and share your knowledge with all the members. I would like to add some more information about this fact, friends. And we have taken more than 7,500. So friends, me, myself, Deepak, Gupta, connected, including today's webinar, it's 90th seminar, and more than 7,500 participants already joined our different webinars. So friends, thank you very much for joining with us for this webinar. And friends, tomorrow we have a session on fees for technical service by CA Sharma and CA Prakash. I request you to kindly join.
Hello.
Anji Deepak ji.
हाँ, so I think संगम जी को सुन नहीं पा रहे, उनकी आवाज नहीं आ पा रही है, तो कॉल ड्रॉप हो गई शायद उनकी.
No, so tomorrow, Sangam ji is talking about tomorrow. So tomorrow we have a session on taxation for technical services. This is being taken by CA Sachin Sinha and CA Prakash Sinha ji. And tomorrow again we have a same interactive session in which in between also I will pose questions to the speaker to make it more interesting and interactive as much as possible, and we'll keep replying your queries. The only request that I have from all the participants is, sir, please do not ask any question which relates to a past lecture. So let us go in the flow of the topic itself. So today also I got many queries about what would be the taxability of capital gain, what is the tax system, etc., etc. My request is you can always take those queries in person on my WhatsApp, and I have replied more than 200 queries from my WhatsApp also during the daytime also. So all the queries which do not pertain to the topic, please ask me on my WhatsApp. On the chat tool, what you have, please ask only the queries relating to the topic which is going on in the class. And for many queries, I write it, please wait, meaning thereby that speaker might be covering it in the next 15, 20 minutes. So that's why I'm not answering your query at that time, because many people said, why not you answer it now? So and subsequently they said, so thank you that it already been answered by the speaker now. So let me make a judgment when to answer a query. So with this, we'll try to make and answer as much as query we can. Even if you still have any query that we can take up offline. So sometimes I got a query, I said the query is not understandable, please call me. So we'll discuss over phone also. And even after the course also, if you have any query, you all have my mobile number available with you, or Sangam ji's mobile number or Deepak ji's mobile number. You can talk to them and get the queries being solved through us. So that's not a problem. So with this, thank you very much for attending. Again, we
Avinash ji, I would like to add two things.
Before going to Deepak ji, I want to add 2 and 3 things. Before going to Deepak ji, I want to explain 2 and 3 things. Friends, all the PPT used in today's session will be available on our website studycafe.in. There is a link for background material of webinars. So friends, up to tomorrow you will get the link there. And friend, there is another link for upcoming webinars. So I request you kindly go there and check our future webinars. And the recording of today's webinar and past webinars is also available on that site, studycafe.in. You will get all 3 material there. And friends, I request you, tomorrow morning we have a webinar on bank audit, in which Amarjit Chopra ji, our past president of ICI, and C. Ajay Kumar Jain will be come at 11:30. So kindly join us for that webinar. The link for joining that webinar is also available at studycafe.in. And in friend, afternoon at 4 to 5, we have another webinar on valuation. So friends, getting more information about upcoming webinars, kindly see our site studycafe.in. Now I hand over to Deepak ji.
Hello friends, first of all I'd like to thank you Rohinton ji for taking such a nice deliberation. Sir, it was very interactive session, and we have seen a lot of queries we came and it has been resolved during the session. And would like to add one more thing. I discussed with Sangam ji and Avinash ji that after the session we will take one objective type test from the participants, and the test will be uploaded on our website studycafe.in. So after the test, we will design a test question as an objective type question test, and participants, those who are listening, they need to appear for the test and clear the test. More information about the test we will share in our upcoming sessions. So it will be test for your knowledge as well, whatever you are learning through this series. So whether you are able to understand things or not, everything will be there, and questions will be designed from the whatever we are telling here and whatever we are teaching here, and passing percentage and everything which will be discussed later on. But yes, we will going to conduct one online test. Objective type questions will be there, and after clearing that you will get the certificate. So we have initially discussed that you will get the certificate. For that certificate, we will conduct the test, and it will be applicable for all the participants, those who are joining through YouTube, and those who are joining through Facebook and our Zoom channel. And today on the YouTube, there were 400 participants live in the initial time. So friends, thank you very much for joining our webinars and giving so much love to us. And please come tomorrow and join our tomorrow's session as well, which is on the bank audit, as well as the tomorrow's evening session as well. If you are not able to see, just want to add one thing. We are sending link of our YouTube channel every day through our broadcast list. But even in case if you are not able to get messages through the broadcast list, just visit the Studycafe channel online on the YouTube. From there, you will see the live lecture will be going on. So do not panic if you are not able to register here because of the limit has been crossed of the 500 participants. we have the limit of 500 participants, which we cannot increase right now. So you can bear with us and just visit YouTube. There it will be live, and you will be able to see the our channel, our webinar live there. Thank you very much. Thank you, Rohinton sir, once again. Thank you, Avinash ji, for taking such an effort and giving so much time, because without your support, this activity would not be possible. So once again, thank you very much for Avinash ji. Kudos, Avinash ji. Thank you.
Thank you, sir. Thank you, Rohinton sir.